covering, as you can see, MCQs and case studies. Okay, various MCQs, those which are repeated in the exam, those MCQs are taken. Those which, that case studies which are repeated in the exam, those are taken. So follow the series completely, starting from today. Follow the series completely. This is the first lecture, so you are not missing anything. Okay? Share it with your friends, share it on all your social media platforms, like the videos, like this video. First, like this video. Share it with your friends also. Okay? Today I will be solving some numericals and the objective questions. Theory 1 as numericals also. A case study type. So follow this video till the end. Share it with your friends. Okay? Chalo, let's move on. So first, let's go to the first question. Banks must adopt a cash flow approach to managing liquidity risk. This is used in which of the following, for which of the following purposes? So banks must adopt the cash flow approach. What is cash flow approach? For managing the liquidity risk. Important one, cash flow approach. There are two approaches, kindly note. One is cash flow, and second one is known as cash budgeting, cash budget. These two are similar ones, okay? These two are similar ones, cash flow and cash budget. But it is said banks must follow cash flow approach. What is cash flow here? Cash flow means present cash flow, present. What is my present cash flow? Suppose if I have to check today, what cash is coming to me, or what money is coming to me, what type of funds are coming to me, I have to check this cash flow. What is cash budgeting? It is mainly used for corporates, companies, while giving the loans. Here it is present plus projected, future. Call it simple. Present plus future cash flows. How do you get this future cash flows? You get it through project report. Project report. While giving the loans, we have this project report, right? So through the project report, you get this future cash flows. But project report, future is always future. You don't know whether it will be fruitful or no. I'll say in future I'll get 10 lakh rupees per day. What's harm in saying? But practically is it possible? So that's why we must always follow the present system while managing the liquidity risk. So now look at the questions here. I was first explaining you the concept. Monitoring on a daily basis their net funding gaps under the normal business conditions. So monitoring the daily gaps, okay, under the normal business conditions. Here, what do you mean by normal business condition? Normal means whatever is going on regularly. See here, if this is your market going on and this is some urgent dip, COVID situation, this is COVID. In COVID you had a market dip. So this is considered as normal, and this is considered as one-off case, one-off, okay, one-off case. So normal means whatever is running in a smooth way without any external pressure, okay, so that is normal. So monitoring the daily cash on a daily basis their net funding gaps under the normal business conditions. And second, conducting regular cash flow analysis based on the range of stress scenarios. So where will we adopt this? Cash flow approach we have to adopt to manage the liquidity risk. For what? Which scenarios? Daily cash flows. Do we manage daily cash flows? Yes, that is true. What about this regular cash flow analysis based on the range of stress scenarios? Stress means what? What all situations can arise? What all can come in the future? Means what all in present scenario also. If there is some problem going on right now only, there's some war or something untoward happens, then immediately the market goes down or the dollar price goes up. So you have to look at that also. So for which conditions must we adopt the cash flow? What will happen? Suppose if I am having surge in the dollar rate goes up immediately, then my cash flow will decrease. Okay? So this is the point. So both the scenarios, 1 and 2. Okay? For 1 and 2, both of them we have to apply this cash flow. Dash risk arises when the bank is unable to conclude a large transaction in a particular instrument near the current market price. Large transaction in a particular instrument means what? What do you mean by this particular instrument? Suppose if I have to buy some bonds, huge bonds I want to buy, 1000 crore bonds I want to buy. Some bond which is very advantageous to me, I feel that the rate is very less now. The price of that bond is very less and I want to buy that bond. Or I want to sell that bond. Anything can be the case. If I feel the rate is too high, I can sell that bond. Anything. Okay? So dash risk arises when the bank is unable to conclude a large transaction. Large. Remember, 1000 crore, 10,000 crore. Okay? Near the current market price, whatever is going on in the market, I must be able to buy it at that rate only. If I am buying at a higher rate, then what's the use? Then what is the risk I am facing? Forex risk, market liquidity risk, funding risk, and call risk. Which risk am I facing? If I am buying a bond at a current market price, means I am not buying the not able to conclude a transaction at a current market price. Take it reverse case. Suppose if I have to sell a bond at the current market price, I am not able to sell it. There are no buyers. So in that case, I will have to reduce the price. What am I doing? When am I reducing the price? Which risk I am facing? Forex? Is it written over here like dollar or anything? Not related. Dollar is not directly related. Market liquidity risk. Market liquidity means near the current market price. There is no liquidity in the market. So is it given like there is an economic situation, some downward economic situation, a recession? No, it's not given. Market is running well, but I am not able to sell. So, funding risk and call risk. Now think over these two. Is it funding risk or is it call risk? You think now. Is it funding risk or is it call risk? Think. What is the call risk? Call risk means what? There are two options. One is called as call, second is called as put. Call and put. Okay, call and put. In call risk, what happens? Call risk means what? The issuer of the bond, kindly note this, issuer of the bond can call back that bond anytime. Call back. Issuer can say that give me back my bond. Call back. Call back the bond. Okay, this is known as issuer's callback. Put means what? The holder of the bond. Holder. Okay. Holder of the bond. Holder means if I am holding the bond, then holder of the bond can sell the bonds anytime. Sell. So is this related in any way to unable to sell that transaction at current market price? Not at all. This is totally different risk. Call risk and put risk are different risk. So the answer over here is funding risk. How funding risk then? Many of you will say, sir, funding risk how? I'm not able to sell. Obviously, how can it not be? See this. I'll give you a simple explanation on this. Funding risk, look at this. Suppose if I am planning to sell a bond, let's say 1000 crores. 1000 crore bonds, I am planning to sell at 120 rupees. per rate, whatever it is, okay? And I'm not able to sell it. Per bond 120. So it will multiply this, okay? So something, whatever that figure is. I'm not able to sell it. I'm able to sell this at 90. 30 difference, 30 into this 1000 crore. Huge deficit, isn't it? So this is known as funding risk. Got it? Clear everyone, this concept, this one clear? Move ahead. Yeah. When the bank provides a loan of 1.5 CR in accordance with the RBI guidelines for a period of 5 years at a rate of interest of 1% over the BPLR. Now BPLR is gone. Let's say repo. Okay, over the repo of the bank. At present, the repo is now BPLR. Take this BPLR as repo or take it MCLR also. Here, there are two types of rates. One is repo and second is MCLR. MCLR is internal rate. This repo is external, EBLR we call it, external benchmark. MCLR is internal benchmark. You can call it anything. Okay. So at present, let's say the repo is at 9%. Let's say repo is not at 9%. The loan shall be repaid in 4 years installment, 4 yearly installment. Okay. With a 1 year moratorium period. So 1 year is a moratorium plus 4 year installment. Funding of the loan shall be done from a deposit of 3 years of the same amount, the rate of interest being 6%. What are the kinds of risks associated with such a loan? It's a composite question, big question. Look at the case. There are two parts. One is loan, second is deposit. Understand this, loan and deposit. What is given about the loan? Amount is same, let's say 1.5 CR. So forget this amount. Amount is same. What is given? Period of 5 years at a rate of 1% over the repo rate. Okay. Presently the repo rate is 9%. So my loan rate is what? 9 plus 1. 9 plus 1. Right? 9 plus 1. So it is 10%. So my loan rate is 10%. Got it? Loan rate is 10%. What is the deposit rate? 6%. 6%. What is the next thing given? 4 yearly installments. So period is what? 1 year moratorium means no EMI will be paid in this period. Moratorium means nothing paid. Cool. Shanti. Plus 4 years. 4 year installments. So total 5 years. What about the deposit? Deposit is of 3 years. Now you are facing a problem. Deposit is of 3 years. What will happen? Imagine you take the loan of deposit of 1.5 crores and then you give a loan of 5 years. Here you are taking it for 3 years. Here you are giving it for 5 years. What will happen? At the end of the maturity of 3 years, this depositor will come to you asking for the money. Give me back my money. And this money you have already gave it as a loan. So as per the RBI, you have to maintain that ALM now, bucket, asset liability management. So in that case, what will you do? In that case, you will have to find out a new deposit. See this, understand the concept, whatever I am telling you. Here you will have to find out after 3 years, for 2 years, here, 2 years are remaining. For 2 years, you will have to find out a new deposit of the same amount, but the problem is, will you get it at 6% at that time? At that time you might get it at 7%, 8%, you don't know. So what is the risk you are facing? Are you facing funding risk? Funding risk, are you facing this means, will you face the funds problem at that time? Then liquidity risk. Will you face a liquidity risk at that time? Liquidity. You might not have the money, required money. Obviously, no, see this, NII gap will be decreased here. Suppose if I get this deposit, new deposit at let's say 8% after 3 years, new deposit. So what is my NII over here? Here the NII was 10%, 10 minus 6, so it was 4%, my NII, right? But here that NII will be 10 minus 8, 2%. So my NII has reduced, so I will be facing the liquidity risk. My spread has reduced, isn't it? Reinvestment risk, that is also a big problem. Why? Will I, at what rate? 8% I am imagining. That rate may be 7%, that rate may be 9%, anything, reinvestment risk. Embedded option risk, this is also one more biggest problem, embedded option. Even this loan person tomorrow morning, this loan person can come to you and take back all your money. I don't want your loan. This is your amount, this is your interest, or this is known as embedded option risk. Or this depositor tomorrow can come tomorrow morning, give me back my money. I don't want your FD. Okay? Take this FD and give me back. Embedded option risk. Anytime anyone can come. This embedded option risk is always there in any banking product. So the answer is 1, 2, 3 and 4. All of them, all of the 4 risks the bank will be facing. Next one, read this. Read this now. Which of the following action can help a bank to satisfy its funding needs? Funding needs. Which of the following action can help the bank in satisfying its funding needs? Think about it. Funding. What do you mean by funding needs? Funding means where can I get the funds at a normal rate of interest? Here, that is important. Understand one important point. Funding risk doesn't mean I'm not getting money. I'm getting money. But at what rate? If I'm getting money at a normal rate of, let's say, deposit, CASA, I'm getting a rate, saving account, I'm getting the rate at 3.5% as a bank. I'm talking from the bank's perspective. If I'm getting money from the customer at 3.5, it's okay. But if I'm getting the money in form of FD at 7%, so it's not okay. Because why? The rate of interest for this is 3.5, the rate of interest for this is 7. Double. If I'm having current accounts more, 0. I don't have to pay any interest. But if I'm having FDs more, 7%, 7.5. So that is the problem. Which of the following actions can help the bank to satisfy its funding risk, funding needs? To dispose of the liquid assets, to increase short-term borrowings, to increase capital fund and liabilities of term maturities, term natures. So what can allow you to satisfy your funding needs? Urgent. See, your funding needs are always for short term. Kindly note. They are always for short term. How can you solve the short term problem? How can you solve the short term problem? Think over it. First one, dispose of the liquid assets. I'm having, let's say, what are liquid assets? Liquid assets means HQLA, we call it. HQLA, high quality liquid assets. Means I am having government bonds, treasury bills, okay, some triple rated bonds. So I can sell it off immediately in the market. So these I can dispose of. Can I do it? Yes, of course, why not? If I am having the assets, I need money, I can sell it. Done. Next, to increase short-term borrowings. To increase the short-term borrowings means give me some money. Udhari, we do it na. 2 दिन के लिए देते. Urgent. परसों दे दूंगा. Same bank also does. Everywhere remember, let it be company, let it be individual, logic is same. You should increase the short term borrowings. हाँ, कल दे दूंगा. So that can also be done. To increase the capital funds and liabilities of term nature. This is something thinkable. You have to think on this point now. Think over it. To increase the capital funds and liabilities of term nature means long-term nature. Term nature means what? I am taking a FD for 5 years. What happens because of this 5 years FD? Very good. That person is giving me money, I'll have to give him after 5 years. So, present problem of mine is solved. Isn't it? So, taking the capital funds or this liabilities of term nature, long-term nature. Isn't it? Capital funds. What is capital funds? Okay, you got this liabilities concept FD. What is this capital funds? Capital funds means I'll take the bonds, means I'll issue the bonds. Here, bonds are issued. Bonds issued of long-term nature. Bonds issued, kindly note, issued, not purchased. I've issued the bonds at long-term nature. I've given you the bonds, you are giving me 10 lakh rupees, I have given you the bond and I'll be giving you after 10 years. Isn't it good for me? Of course, rate is a problem, but my present problem is solved. Funding risk is generally of short-term nature. So answer is this. Got it? Next one. Which of the following is a part of liquidity risk? Which of the following is a part of liquidity risk? Liquidity means I'm not having cash flow to pay my normal EMIs. In bank also we face the liquidity risk. The liquidity risk in the bank is I don't have money to pay my depositors. Right now I have to pay to the depositors. I don't have money. Liquidity risk. So, which of the following is a part of liquidity risk? Funding risk, time risk, call risk, and fourth is liquidation risk. Which of the following is a part of liquidity risk? Funding risk means I am not having enough funds at a given rate or acceptable rate. Got it? So funding risk is there, obviously. Funding risk is there because if I am having, let's say I have to pay the depositor at 7% and I am getting the funds from somebody at let's say 15%. What's the use? I am taking it at 15% and closing this depositor of 7%. So I am creating a new depositor of 15%. It is not a business, isn't it? Got this? So that's why funding risk, yes. What about the second one? Time risk. What is time risk? Time risk means management of time. At the time of my deposit maturing, I must get the enough funds. Okay? If I don't have it, if there's a time mismatch, then definitely what will happen? Definitely the things will be like this. What will happen? If I don't follow the right timing for deposits and liabilities, what will happen? It will be a problem for me. Why? I'll be facing this liquidity risk again because I have to pay the depositors. I don't have money at that time. So time risk, call risk. Call risk means, will you face this call risk? Call risk. Call risk means somebody takes back, just now I explained you, the issuer takes back the bonds. This is not possible. Of course, call risk is there, but in this situation, it is not the part. Liquidity. Okay? Similarly, last one, liquidation. Liquidation means what? I am not able to sell the bonds. Now understand the concept of liquidity versus liquidation. Liquidation means I am not able to sell the bond. No buyer. Keep it very simple. No buyer for my bond. No buyer for my bond. If there is no buyer for my bond, then why have I purchased that bond? Simple. I am in trading. I am following liquidity means short term. Whenever I am doing a short term trading, I must always follow those bonds only which are having immediate buyers. Otherwise, why should I buy it? If I am buying some bonds which is not purchasable, then I am a crack. When I don't know banking, it means, see, always remember, for short-term trading or liquidity, short-term liquidity, you must always follow those bonds. You must always buy those bonds which are immediately sellable. Immediately sellable. Only then buy this. If you are investing for the long term, investment for the long term, in that case what you should do is, you must buy those which are underdogs. At that time you will buy underdogs. Underdogs means what? Those who don't have value right now, but further in future they will have the huge value. But that is for investing. That is not for your liquidity or trading. So if I am buying some liquidation problem bonds, somebody is having liquidation problem, nobody is buying it, I am not in that business correctly. So the answer is C, 1 and 2 only, isn't it? Got it, everyone? It's 1 and 2. Understand the concept of liquidation. Very important. Liquidity and investment. Sellable underdogs. You must understand this concept very properly. Otherwise, if you don't understand, you will get confused in these. Next. Which of the following statements is not true for RTGS? This is the simplest one possible. Simplest one. Read this. I will not read this. You will immediately get the answer. Think over it. Not true for RTGS. Transactions are processed continuously on a transaction T by T basis. This much you must know at the CAIIB level. Okay? The RTGS system is primarily meant for large value transactions. The minimum amount to be remitted through RTGS is 500 and maximum is 2 lakh. RBI has waived processing charges levied by it for RTGS. This much you must know. This answer you should know definitely. If somebody is not knowing this, then very difficult situation in CAIIB. Okay? The answer is C. Minimum amount 5 rupee, 500, and what is all this? RTGS has minimum amount of 2 lakh rupees. 2 lakh. That's why we call it high value, large value transactions. If I am calling large value and then saying 2 lakh, is 2 lakh a large value? Okay, so this is gone. Okay, so remaining all are correct. Processed T by T basis. That's why it's called. What do you mean by T by T basis? T by T means transaction by transaction. Means what? You understand the word RTGS, real time gross settlement. Gross means what? This word gross means this T by T. Gross. Everything is done right now on this transaction only. Second transaction, second gross. Third transaction, third gross. Large value, obviously you know this. Large value. RBI has waived the charges. Now RBI has waived the charges for NEFT, RTGS, everything. Now you must pass it on to the customers. That's what RBI says. Okay. Next. Need to replace net outflows due to unanticipated withdrawals or non-renewal of deposits is called as. Need to replace net outflows means net outflows. Money is going out from my bank, constantly going out. Okay, somebody is withdrawing, constant withdrawals are going on in my bank. Unanticipated, something I didn't think, some problem came in the economy. People are afraid, they are withdrawing a lot. Unanticipated withdrawal or non-renewal of deposit. People are not renewing the deposit. Why the rate of interest has gone down immediately? People are not renewing it. So it is called as what? Funding risk, time risk, call risk or liquidation risk. What is it? Now it can have various answers. Okay? It can have various answers. There can be 3-4 more risks which can be in this. Okay, it's called as embedded option risk also. Embedded option is also correct. Nobody is ready to withdraw your, redeposit your FDs or reinvestment risk. That is also correct. Nobody is ready to reinvest. But here the question is, among the four options, which one is correct? That is the question. Funding, time, call or liquidation. Liquidation is out. Liquidation means I am not able to sell my bonds. That is totally out. Okay. Call means what? Call risk. Again, it's related to bonds. Out here, are we talking of bonds? No. Deposits we are talking of. Funding and time. Time risk. What will I face? Net outflows due to unanticipated withdrawals. Which one is more appropriate over here? Which one is more appropriate? If the withdrawals go on from my bank, see this is my bank. Okay? Here the depositors are depositing the money. Depositors. How does my bank function? This is my depositor and I give the money to my loans. Loans. Okay? So I give the money to my loans. Okay? Now what happens? This depositor does not deposit the money. Now this stops. These loans which I have funded or given, this person will give me the return, but if the situation goes down, this person will also not pay me. In COVID, what happened? There were a lot of defaults. So this will create a funding risk for me because I don't have money. This money is gone. Nobody is giving me money. That will lead to a funding risk. Most appropriate answer. Got it? Next one. Which of the following are the reasons for high treasury risk? High treasury risk. Which are these? Read this, read them. Read the statements. Statement 1. Low funding is required due to high leverage, which may result in straight loss of capital. Low funding is required due to high leverage. Now, reasons of high treasury risk. Low funding is required. Is this a problem? It's a good sign. Next, large size of transactions are done. So, large size of transactions are done. So, size of the transaction is huge. Okay. Statement 3. In treasury, transactions once confirmed are irreversible and may thus result in short-term loss. Now, which one is true? Think over it. Low funding is required due to high leverage. So, leverage is high. So, is there a huge risk over here? It may result in loss of capital. So, as the leverage is high, see this term is an advantage, but this term is a problem, leverage. And this will result definitely in loss of capital. If I am having leverage means just now I told you 100 rupees I am having and I am giving the loans or taking money from outside 500 rupees. So 100 rupees capital, 500 rupees I am taking. 400, where will the gap be filled in? That is known as leverage. So this leverage, if my whole cycle stops, it will result in straight loss of capital. Right? Large size of transactions, obviously, per transaction it is huge. 1000 crores, 2000 crores, 10,000 crores. Irreversible. Once I do the transaction, enter, gone. No change can be made. 1, 2 and 3, all are. Now before going, let me show you the sessions, the new batches which have started, paid batches. Join these ASAP. Just now they have started. All the numericals, objective questions, case studies, everything is covered in these paid batches. In half an hour session, YT session and 1 hour sessions, we can't cover all the points. So that's why join the paid batches. These go hand in hand with the YT series and the paid batches. How to join? See here. Always go through the app. In the app, you will be getting 1% extra. Okay? Go to that 24/7. Click on JIB and CIB. With this. Click on JIB and CIB. I'll show you the simplest way. See this. Click on JIB and CIB. Click on CIB June 25. See this. The batches. View all. All the courses are available. Look at this. CIB extreme courses are available. Hindi plus English combined. This is also available. Then click on view all. You'll see all the courses. Look at this. Extreme. Then you'll see the selection pro batches. BFM batches. Separate batches. You are getting all this. ABM, BFM. All the batches you are getting. Join anyone. And right now you are seeing the huge discount offer going on. Huge discount. What is it? Let's see. See this. If you join this video course, 517 videos, Hindi and English both, ebooks, mock tests, expert faculties, high quality videos, video material, self-paced learning, device compatibility. You can be on any device, app, this Android or iPhone or tab, anyone. How to get it? Click on this. Never forget the code Y432. That will give you the huge discount Y432. See this. 80% discount you are getting plus 1% extra using the app. So that's why 81% discount you are getting. So don't miss this. Also you can join the Mahapack. In Mahapack you are getting multiple batches, 15 plus batches per subject. Look at this. In Mahapack, CIB Mahapack if you join, you are getting 15 plus batches per subject. See this selection pro batch. This is also available. Live batch that is available. You can join this batch also using the same method. Mahapack. Look at this Mahapack. CIB Mahapack 2.0. 15 plus batches per subject you are getting. Plus ebooks, mock tests, marathons, electives, everything you are getting. So don't miss this. This is one of the best alternatives available for you. Again, and right now you are getting double validity. You buy for 6 months, you are getting for 12 months. Buy for 12 months, you are getting for 24 months. Okay? And how? Same method. Method doesn't change. Buy now. Put the code Y432. Y432. Look at this. 80% discount. Plus 1% through the app. Remember this. Don't miss even this 1%. This 1% through the app is one of the best things. Here, why don't you want 1% extra through the app? Okay? Everyone wants extra, right? 1% through the app. So download the app and go through the app only. Okay? So plus double validity, 12 plus 12 months. So don't miss this. It's available for all JIB, CIB.